The portfolio update you have all been waiting for. This is my Trading 212 final update for 2022. And this year has been the craziest year in terms of stock market investing for a very, very long time. And I know during the pandemic, there has been an onslaught of new people trying to invest and getting into investing. And this is definitely the first hurdle these new investors have ever gotten through. And of course, investing is not easy. A lot of people have dropped out of investing because they've seen the stock market go down 20-30%. But this is part and parcel of investing, and today I'm going to show you my Trading 212 portfolio. So if you do want to sign up to Trading 212 free, you can use my link in the description down below and we will both receive a free share. So that helps me out if you want to do that, and I will be very appreciative of that. So without further ado, let's get straight into the portfolio. So when I log into my Trading 212 account, you can see that my total portfolio value as of today is £441.33, and my account value is £443.09. So like I said, over the past month, the stock market has been incredibly crazy. We have seen peaks and troughs and the whole portfolio looks like it's crazy. So actually, over the past week, the CPI numbers of the US have been released, and also the inflation numbers of the UK, and they were both lower than expected, which led to a big rally in the stock market, which was not long lasted, and things have dropped down again. So another reason why you shouldn't always take experts' advice, because even though the CPI numbers were lower and the stock market rallied, that was quickly cancelled by a downturn in the market, because the stock market doesn't follow any rules, it doesn't follow any patterns or trajectories. The only thing it does do in the overall long term is to go up as a function of time. That is why I am a long-term investor. That is why this channel is about long-term investing. Even with a portfolio value of only around £400, it is about consistently investing small chunks of money with the goal of building our wealth, and also learning more about the stock market, gaining all these skills that we can use in other parts of our life. So that being said, let's go through all the holdings that I have right now, my kind of strategies of investing on Trading 212, and then I will look at my almost daily dividend pie and see how that's going. So I have 9.2 shares in Vodafone, and that is down by 23%, which is quite a bit if you ask me. Vanguard FTSE All World High Dividend Yield, I have 0.02 shares, and I'm not really sure why I'm holding on to this, but I do have it. It is nice on Trading 212 that you can have fractional shares even as small as this, so I thought I'll just keep it and see how, you know, the Vanguard FTSE does. Unilever, I have 0.02 shares in that, and that is up by 6%, which is quite modest. So Starbucks, I have 0.2 shares, and that is down by 1%, which is minus 18p. Rolls-Royce is up by 18%, and in particular, Rolls-Royce has had an incredibly bumpy road, no pun intended, in terms of its performance over the past month. As you can see, a big peak on the 12th, and then a huge reduction in the stock price. Pinterest is pretty much stable at a 1% loss. The National Grid, I have 0.49 shares, and that is down by 0.6%, which is not too bad. So I have 2 shares in the iShares S&P 500, so that's the GSPX, and that is down by 1.57%, which is crazy because the S&P 500 over the past month has also been doing crazy things, with a peak right about where the CPI numbers were released, and then a huge dip that was lower than the previous low. We will come back to the S&P 500 because that will be my investing strategy going forward. I have 6 shares in Royal Mail, which is now called International Distribution something, and that is down by 3%. H&M, which I didn't know stood for I'm not going to try to pronounce that, it might be French, that is down by 3%, and I have 1.05 shares in that. Not too bad. GSK is doing quite well at a plus 7.5%, and I have 0.2 shares in that. Fiverr is down by quite a large amount, actually 16%, and it looks like there's been a steady decline, and over the year it's been a steady decline. And as you can see from the pandemic era peaks, this company is not doing so well in terms of valuation, even though I think relatively that the business idea, business model going forward could be very useful. That's why I have invested a tiny amount in Fiverr, and of which I might invest a lot more. EasyJet is surprisingly steady at a 1% increase, and I have 0.28 shares of that. Direct Line Insurance is actually up by 8%, and I have around 2 shares in that. The Decker DAX Plus Maximum Dividend is up by 1%. Carnival, I have exactly 1 share because that was a free share when I signed up to Trading 212, and that is down by 12.8%, and that's a 90p loss. Aston Martin is actually up, which is actually surprising. So Aston Martin, I have 1.3 shares in that. I have a lot more shares of that in my free trade account, but that is up by 20%, which isn't too surprising because Aston Martin was valued at like £60 at one point. Amazon I have a very small amount of 0.04 shares, and that is down by a big 15%. Alibaba 0.01 shares, down by 10%. Airbnb I have 0.012 shares, and that is down by 8%, so not too bad. AMD, let's see how they have been doing over the past month. Exactly same as other tech companies, and it looks like the stock market is getting battered right now in terms of like the S&P 500, so it's a very tech heavy index. And like I said, it looks like the same kind of profile going on with all these tech companies, with maybe just a glimmer of hope coming over here where there might be a recovery, but who knows. At the end of the year, the stock market becomes quite unpredictable. A lot of people might be selling off their shares, leading to a decrease in value. Loads of factors come into play. It's not just one thing or another. That's why looking at all these graphs online of people trying to read graphs and candlesticks and telling you that the S&P 500 is going to go up and down is just, in my opinion, waste of time, because you're not actually going to get useful information on that. No one's going to tell you the right information because they themselves don't know it. So the only thing that we can control as investors is to put in our money frequently as we can into probably broad-based index funds with low costs that move up as a function of time with the market. But of course, we're still going to all try to pick individual stocks that do well, and that's why I only invest very small amounts in individual stocks, because it's a fun way of seeing how many percentage increase points you would have instead of actually risking money. If I saw a company go up 100%, I'll be like, yes, I've invested in a company that went up 100%. But then some people will think, why didn't I put more money in that? I could have doubled my money. But it is what it is. You can invest how you want to invest, but statistically speaking, investing in ETFs over a long period of time, you're probably going to get higher returns like that. I also wanted to thank the 2 people who have used this link to sign up to Trading 212. Just a reminder, you can use the link in the description box down below to sign up to Trading 212, and I will receive a share and you will receive a share. Of course, that's completely up to you, but thank you for the 2 people who have signed up, and they have given me in total £19.76, so I'm grateful. Additionally, I wanted to update you guys that I'm thinking of starting my ISA of April of next year in Trading 212 for the first time. So I've never had an ISA outside of free trade, and I'm thinking of putting it into Trading 212 and just buying GSPX. So I said I'll come back to this. So currently I'm only buying the GSPX because what it is the S&P 500. However, it's hedged against currency changes between the pound and the dollar and maybe some other currency that they use in trading internationally. And this is more reflective of the American stock market. Is pretty much 1-to-1 with the American stock market. Things like VUSA, so the Vanguard S&P 500, there we go, first go, is not reflective of the American stock market. As you can see, it's flatlined over the past year because of the changes in the pound and the dollar too, because the pound went down against the dollar and we saw the dollar go up in value, and we didn't see a lot of the decrease in value of the S&P 500 from the American side because the dollar was so much more valuable that we didn't see a huge loss. Also, because we didn't see a huge loss in our portfolio, we weren't provided with the opportunity to buy at a much lower price. So essentially when it goes back up, we're going to miss out on 10 to 20%. So I thought, you know what, let's just invest in the hedged one. Although be warned, the hedged ETF is not perfect in its own right. It is slightly more expensive in terms of total expense ratio than the Vanguard S&P 500, and also the hedging is not perfect and there might be some other issues down the line. So overall, my portfolio is down by 3%, which is a negative 14.5%. And actually, since starting investing back in September in this portfolio, I've not really seen a negative month. So it just goes to show how bad the past few weeks have been for investing, where my portfolio is down by 3% and it was probably up by 1 or 2% last time. So that's a 5% loss. And I'm investing more selectively than other people. So people who have stayed investing probably would have lost more money than I have lost. So you can actually see in the beginning of December, I was up by 1% plus £4, and now I'm down 3% minus £14. So that was an overview of my investments, and now I'm going to go to the pies and check my almost daily dividend pie. So if you guys want to actually check out this pie, I will leave a link in the description down below where you can actually sign up or view this pie. The whole purpose of this pie was to get myself some exposure into dividend investing. I am not at all a dividend investor. I see more capital growth as the kind of investing strategy that I am familiar with, and of course dividend investing is slightly different from capital growth investing because a company has to give out dividends in order to attract shareholders, and that money they could potentially use into the business to expand and make more profit in the long run. So there's kind of a balancing act going on. But that being said, the almost daily dividend portfolio for the first time is doing really bad. It's down by 3%, which is very similar to our other portfolio, and that is a result of a negative £10 £100. We can see in the holdings that most of these companies are red too, and last month most of these were actually green. So we can see Apple's down by 14%, 3M's down by 6%, Canadian Natural Resources down by 14%, LTC Properties down by 11%, Bank of Montreal down by 10%, and all these other companies that are not doing so well. So I've invested in total £350, and the recommended minimum amount for this portfolio is £400, and I don't think I'm going to put more money into this portfolio, so you guys can come and see next month how this portfolio, without any additional payments being made, how it works. So I've actually received quite a few dividends until this point. So the total amount of dividends I've received is 99p. And if I go into my notifications, we can see that yesterday I received 2p from Stag, 2p from Realty Income, 3p from McDonald's, and 3p from Main Street Capital Corp. And the premise of this portfolio is that you receive regular dividends almost every day, or probably more realistically a few days a week, where you will receive dividends. Of course, the higher the value of your portfolio, the more money that you initially put in, the higher the dividend numbers are going to be. Once you hold this portfolio for a few months and you go past the ex-dividend dates, you will start to see some of the dividends rolling in, and the longer time you've invested in and the more money that you put in, you'll see the dividends appearing faster and faster and faster, till a point where if you put enough money in, you will see that you will get maybe £10, £20, hundreds of pounds per month just in dividends, and you can just reinvest this and the snowballing effect will come into play and the portfolio will grow and grow. That being said, even though it's a pie, there is no guarantee that some of these companies will not go bust. Even though it's quite well diversified with 50 companies, there's no guarantee that some of these companies won't go down. So take that for what it is. There's no guarantee that some of these companies won't cut their dividends. There's no guarantee that some of these companies won't reduce their dividends. So that is one of the things that you have to look out for as a dividend investor, as well as if you're a normal investor. You have to realize that some of these companies, just by the nature of things, will go bankrupt. It's just how the economic structure works. So I really hope you guys have a wonderful Christmas. Make sure to check out some of my other videos, and I will see you in the next video.